What kind of strategy can you use in this funky market? We have this gradual drift higher, lots of pending news, big gaps up. I'm going to address that in just a second. Before we get started in today's video, please hit that like button, subscribe to my YouTube channel, and share this video. It's going to help me reach more traders. If you find this content useful, it's going to help me grow my channel. So the strategy that I've been using is to sell puts. I'm trying to take advantage of accelerated time premium decay, and I'm trying to distance myself from the action. I had 6 positions expire worthless today, and I think each of them generated somewhere in the neighborhood of an 8 to 10% return over the course of just 3 weeks. So we're going to be taking a look at a pick. Actually, I've got a couple of picks that I'll highlight at the end of the video, so make sure that you stay tuned. Let's take a look at what my recent picks have done. I had J&J, and I did give you an update on this last week. We did a call debit spread when the stock was up here. It had just announced earnings, and we were looking for a stock that looked poised to grind higher. J&J pulled back a little bit. The spread is still in decent shape. We have the 190, 195 call debit spread. We paid $3 for it. It expires November 21st, so we've got plenty of time with it right now. How would I be managing this trade? Well, the stock did pull back just a little bit. There was news that they were not able to settle their talcum powder lawsuits, so now they're going to have to go to trial. And so there were some people that were in the stock here that were hoping for that type of resolution, but now it's going to drag out for years. I don't see this impacting the stock. I think it's going to continue to grind higher. So I'd like to see it get back above AVWAB-E. If I start getting another week or two from now and I can buy those 195 calls in and I have decent upward momentum in the stock, I may leg out of it and buy the 195 calls in and let the 190s run. I'm trying to make 60 cents on this, a 20% return on that trade. So if I can sell the spread as a spread for $3.60, I'll be looking to exit it that way. So stock rebounded nicely this week. Everything's looking pretty good. Last week I highlighted AVGO. I really like that stock. We weren't able to get the dang spread up because the market rallied like gangbusters right out of the gate Monday morning. So here's what the market did. We were all the way down here trying to get a bullish put spread off all the way down here at the 325 level. So we're trying to sell the 325, 320 bullish put spread, put credit spread, and get $1 for that spread. We weren't able to get it done because the stock ran up with the market. But you can see how the stock has performed well. Now, if I'm looking at it, I'd like to see this breakout hold. I'm not trading it right now. I want to distance myself from the action. Again, I'm trying to sell time premium. So AVGO, nice pick. Stock did really, really well the first 3 days this week, and now it's starting to settle down a little bit. In fact, you can see how the market is also starting to settle a little bit. So let's talk about what happened last week in terms of the news that was driving the market. Heading into the week, fairly difficult week for us to trade because we had a lot of earnings pending. We also had the FOMC statement on Wednesday, so it was difficult to take a position, at least a directional one, because the market could have gone either way. So when we came in Monday last week, we also had a big gap up right there, right out of the gate. The market gapped higher, and it was difficult to actually, this was the price action on Monday. It was difficult to chase this market higher. And what did it do? Did it gap and continue to rally? No, it kind of gapped up and then it sat there. And then Tuesday it gapped up and it sat there. Wednesday we had a little bit of movement off of the FOMC statement, and Thursday and Friday after mega cap tech earnings, the market has been kind of chopping around. So we had earnings announcements from Meta. That was the weakest of the mega cap tech stocks. It did not fare well. In fact, Meta has broken below the 200-day moving average. Very weak looking stock right now, heavy volume. So I wouldn't touch Meta right now. In general, anytime it gets below the 200-day moving average like this, what you would like to see is you'd like to see it pop right back above that 200-day moving average and hold. That would tell you that buyers are viewing this as a decent entry point for the stock. The other companies that announced did fairly well. Microsoft, Google, Amazon, Apple, all put in pretty solid performances, but there wasn't a lot of follow-through buying. So the big news was the FOMC statement. The Fed cut interest rates by 1/4 point. That was widely expected. So during his press conference, Powell was asked, so are you going to be cutting rates again in December? Because right now the Fed fund futures are pricing in, I think, a 90% likelihood that you're going to be cutting rates again this year. And Powell said it's not a foregone conclusion, meaning, yeah, we could. It's not 100%. I'm not going to guarantee you that we're going to do a rate cut, but it's pretty likely, I think. And for the same reasons that I explained last week, I feel that the Fed is going to err on the side of caution right now. We have the government shutdown continuing to loom, and we've got the Fed repo window being tapped by banks. So that is a sign there could be a little bit of a liquidity crunch. We had CPI come out. That was in decent shape. So that gave the Fed some breathing room. We don't know what the job scene is right now because the government's been shut down. We're not getting any employment data. And we are actually going to be getting that type of information this week. ADP and Challenger Grain Christmas are going to release their reports. Now, ADP last week came out and gave us a preliminary look of where they feel the number is going to come out. And this company processes payrolls for medium-sized companies. And they said that based on their findings, they feel that 55,000 new jobs were created during the month of October in the private sector. That's a pretty solid number. And the previous month, September, they had reported a drop of 37,000. So if they post that number this week, and I think the expectations will be there since they posted their preliminary number, that's not too bad. It should be supportive for the market. So all things considered, I think that the Fed is going to err on the side of cutting rates again. They did also stop their quantitative tightening, and that is another form of easing. So from a Fed standpoint, they're dovish right now. So that's good. We've got seasonal strength also working in our favor right now. So into year end, asset managers like to mark up their portfolios. They get paid on assets under management. The bigger their assets are, the higher those valuations are, the bigger their percentage pay is, the bigger their bonuses are. They also like having their customers open their financial statements at year end. It's a nice, warm fuzzy that makes everybody feel good. That year end strength is something that I've always leaned into. So I am going to be trading from the long side. Now, can I go gonzo right here? No, not really. So if I take a look at the price action from last week, this is really tough. So here's the big sell-off that we had, and this was when Trump said that he was going to increase tariffs on China, and that was another development that we had last week. Big sell-off, and then the market was able to rebound from it. And then we had this gap up and a compression, gap up, compression, gap up, compression, very light volume. So this is basically what I consider to be a seller's boycott. When nobody's selling stocks, even a small bid can drive prices higher. And that's exactly what happened. So it wasn't as if we had buy coming in, stacked long green candles on heavy volume, aggressive buying, urgency on the part of asset managers. No, we're not seeing that. And that makes trading more difficult because we don't have that confidence. We don't have that sense of urgency. And when we do have urgency, then we're able to predict future price movement. So we don't have that working in our favor right now, but what we do have is a market that's floating higher. So when we have go, gotta have them market conditions, then we're going to be aggressively buying ourselves. How do I get into that state of mind? What is it going to take? What could I possibly see that would get me into that mode? I would need to see a nice sustained pullback for at least a few days. None of this garbage, one and done. One and done based on a statement about tariffs. No, that's not going to get me super aggressive. I need to see 3 or 4 days, market finding support at a major moving average, some type of support level, and then flying off of it. That's going to give me enough time to evaluate which stocks have relative strength, which ones want to lead the move higher. Those are the ones that I'm going to be buying. And then I can get aggressive. I can buy some in-the-money calls on those, especially into year end, on the notion that the market's going to take off. I don't have that right now, and I'm not expecting a big pullback in the course of the next 2 months. So, alternatively, what would I like to see next week? This horizontal breakout right here. So let's get that high. That high was around the 674 level, let's call it. Let's call it 675. Let's use round numbers. So 675, what would I like to see? I'd like to see us pull back. It can be gradual. Pull back to that 675 level. Digest some of these earnings gains that we've had over the course of the last week. And we're going to have a heavy dose of earnings again this upcoming week. So lots of earnings announcements. I would like to see the market pull back, and I'd like to see it test that 675 level and then boom, fly off of it with a nice long green candle. Is that going to get me buying longer term calls, maybe December calls into year end? Probably not, just because of this choppy price action that I'm currently seeing. And there have been headwinds all year. Global economic growth has not been good. China just posted its weakest GDP number. Europe is struggling. There's just not a lot of global growth right now. So as far as news, I did mention earlier that Trump went to the Far East and he did sign some deals. So that's pretty positive for the market. Anytime that we're able to stabilize our relationship with China, I think it's good for the market. This is what caused that big sell-off, and now everybody's playing nice in the sandbox, or so it would seem. Rare earth minerals, China promised that they were going to open up their exports for rare earth minerals for another year. Trump had agreed to lower tariffs, but China still hasn't removed those licensing restrictions that they have on rare earth minerals. So we'll see what happens. So right now, I'm playing it pretty cautious. I am bullish, but I'm not super overly confident in what the market's going to be doing from this point on. And that's why I'm choosing the strategy that I have. Market conditions dictate the strategies that we use. And so if I'm looking at this longer term market uptrend, when would I get super bullish? It's going to take a nice pullback, and then coming out of that pullback, I'm going to be expecting 2, 3, 4 weeks of really nice, steady price movement higher. Nice, orderly candles. That is when I can get aggressive. But I'm not expecting to see that type of a pullback, so I'm going to distance myself from the action, sell some out of the money put premium, take advantage of time premium decay. That's a strategy. Generate income. What happens if I'm using this strategy and we get one of these? I'm not as afraid of one of these, by the way. One long solo candle, even on a 5-minute chart, is not something that we need to be afraid of. And it's certainly not something that you act on. What you want to do is you want to use that as a landmark, and you want to evaluate the price action that follows. So if this candle holds and you start moving and you can't get back into the body of the candle, that's a sign that it's going to be pretty legitimate. In this case, boom, we go right back to the halfway point of that long candle, and then we continue to grind higher, indicating that no, that is not a legitimate move. What I would be more concerned about is if you had 5, 6, 7 consecutive medium-sized red candles, one after the other, moving lower. That's persistent selling. That tells you that sellers are in control. So when you get this type of price movement, you want to see what happens after that long red candle. And as I mentioned, in this case, you didn't need to worry about it. If I got 5 red candles consecutively along the way, especially if we start taking out horizontal resistance here at 675, we take out AVGO. Okay, well now I'm going to have to protect some of my puts that I've sold, and I'm just going to short futures. Why would I do that? Well, I want to protect myself instead of trying to close down 8 or 10 or 12 different bearish put positions where I have to navigate option bid-ask spreads. And by the way, some of these option bid-ask spreads are widening out quite a bit. And as soon as you get any kind of market volatility, that's what market makers do, is they widen the heck out of these things, and you can't get out of the position. You can't get out very easily, that's for sure. So if you short futures, you're able to protect yourself as the market goes down and still preserve those positions. If you pick really good stocks, they're going to have relative strength. They will hold up well relative to the market. So when the market finds support and it starts to rally back up, then you can take your gains on your futures position, you leave your naked puts out there, and then they eventually expire worthless. And the stocks that you're selling naked puts on, you do want to be able to take assignments. So you should hold half of the strike price in reserve. When I calculate my returns and I tell you that I'm making an 8-10% return in 3-4 weeks, that's based on holding half of the strike price in reserve. Now, that's not the exchange minimum margin requirement. Exchange minimum margin requirement is about 20% of the strike price, so considerably less. The problem is that if you over leverage and you get a market move against you, you're not going to be able to take assignment on those stocks because you don't have enough funds available. So as long as you hold half the strike price in reserve, you're going to be just fine. And a 5 to 10% return over the course of 3-4 weeks, when you have kind of uncertain market conditions like this, where you can't really fully get behind it, that's a decent way to generate some income while you're waiting for that really good setup. So that's why I'm using this strategy. It's been very, very effective. And now we're going to take a look and see what we've got as far as a couple of trades that might set up for us. So I'm going to bring up custom search. In all my videos, this is Option Stalker Pro. This is software that I developed specifically to trade the system that I'm teaching you. So it's a search engine first and foremost. It's got fantastic stock searches. We also have custom search, and this is where we can go in and really identify the variables that are going to present us with attractive candidates. And so right now, we're in the thick of earnings season. That presents us with a lot of opportunities. So one of the primary variables that I want to use is show me a stock that has announced earnings in the last day or the last 30 days. And the reason that I use this variable is because I want to be past that earnings announcement, and I want to be able to gauge what the reaction was. Was it positive? Yes. Good. That tells me that asset managers want to own this stock. And so I also want to make sure that the stock has had decent upside movement and that it's in a nice trend. So I'm not looking to bottom fish here. And so I'm going to make sure that it's above the 50-day, 100-day, and 200-day SMAs. I also want to make sure that it has decent option liquidity. And I'd like to have some higher option implied volatility. Why? Because that allows me to distance myself from the action. Okay. The higher that option implied volatility is, the more I'm going to be able to generate in terms of income, and the farther I'll be able to distance myself from the current stock price. So these are the candidates that came up. And one word of caution: when you have high option implied volatilities, they're there for a reason. Okay. This isn't an accident. The market makers price that in because they see that the stock moves and that there's a decent amount of risk to it. So anytime that you're looking to make big returns, you're going to be taking big risks. You assess those risks. And in our case, we're looking for really strong stocks, and we're using technicals to support our decision. Those technicals are telling us that asset managers want to own these stocks. That's how we get our odds up. But that's not to say that these stocks can't roll over if the market starts to soften or weaken. So here are some of the candidates that we have. I'm going to just look at the top two right here. Okay, these are just alphabetical, but I know both of these stocks set up well. And you're going to see QS, I think they just released earnings. VKTX, that's been a nice one. That's a post earnings. That's a drug company that's got an obesity drug. APLD is a data center company. And you can see that the stock has been in a really nice grind higher. It's currently at about 34.66. And you can see that it announced earnings right here, and it gapped up. And it came back and it checked that breakout right here. So what is that low? And that low is about $29. Great. So here's the tell for me. First of all, asset managers have been buying this stock. The volume has been good. The price action has been very steady. So they want to own this stock. Nice, orderly, tight. If they were going to smash this stock, they would have done so right there on that earnings announcement. Oh, whoa, look at that. They didn't meet the number, or it wasn't up to our expectations. The stock's already run so far. Take profits. Blam. The stock falls. That's not what happened. No, they said, hey, you know what? This is in line with our expectations. This is a pretty decent number. In fact, we really like it. And so they came in and they bought the stock. We've had a little bit of market volatility in here. And what has the stock done? I mean, you had that big day on October 10th. I believe that was back here. So the market does that. What does the stock do? It holds its own beautifully. So this tells me that they want to own this stock, and I would like to own this stock. Where would I like to own it? I'd like to own it at $29 right on that breakout. Okay, well, let's take a look at the $29 puts, and let's go out to November 21st. This is only 3 weeks out from right now. So we'll take a look at those $29 puts and see where they're trading. $1.40 by $1.60. So if I'm putting up half of the strike price, I'm going to have to put up roughly $14.50, and I'm getting, let's say, $1.45 for these. That's a 10% return in 3 weeks. With all this crappy kind of price movement in the market, will it go up? Will it go down? This is the kind of trade that I've been doing very successfully. It's a great way to generate income. Data center, AI, that's what this company does. So yes, looks really good. And I'm willing to buy that stock at $29. But if I sell those for, let's say, $1.50, my actual cost is going to be $27.50 if I consider the premium that I got. Well, that's about a 20% drop from where the stock price is right now. So let me recap this strategy for you. In the next 3 weeks, If the stock does not drop 20%, I get to make 10%. That's a good deal for me. I am willing to take that risk. BE. Love it. You know I love it. I've been loving this stock for a long time. I was waiting for the earnings. I wanted to see what the reaction was going to be. They announced earnings this week. Are they going to smash this stock down? No, they didn't. They liked it. It gapped up, and now it's been able to hold its own. That tells me that buyers are supporting the stock. They like this stock. Well, where would I want to buy this? Got a really nice breakout right in here. So yeah, I would be wanting to buy that stock right here. I get to own it all the way back here. Sure, I'll do that. Well, what was that low? $88. Let's see what we can get for the $88 puts or something near that. So we've got $5 increments here, and we can see that for the $90 puts, we can bring in $1.70 in premium. That's going to give me a net cost of somewhere around $88.30. That's below 89. So I'm going to have to put up $45 for this one. So fair amount of money. What am I going to be making on it? Somewhere in the 5% range. That's going to be the gain that I make in 3 weeks. 3 weeks. That's a nice return. And you don't have to sweat it either. So again, yes, the stock looks great. They want to own this stock, and I am all the way down here. Stock is at 132. I'm selling an $89 put. Okay, so we're way the heck out of the money on this one. More than 20%. Same kind of deal. Stock holds its own. Time, premium decay, market backdrop, strong. No reason for this stock to roll over. If it was going to, they would have smashed it already. This company had 50% year over year revenue growth. They're nailing it, and they provide power solutions to data centers, particularly using natural gas. So I like it. I think this is a great type of stock that I would want to own, and I'm all the way down here selling those naked puts. So this is a strategy that you should learn. It's a relatively conservative strategy. In fact, naked put writing is an equivalent position to covered call writing, as long as you're not doing it on a leveraged basis. You can do covered call writing where you buy the stock on margin and sell at the money calls against it. Absolutely. In this particular case, a covered call on this stock would be if you bought the stock and you sold a $90 call. That would be an equivalent position to selling a naked $90 put, except we only have one transaction. We don't have to actually have the stock position. And in the meantime, our margin requirement is 20%. So we're able to kind of use some of our capital while we're waiting for that option to expire. So there are advantages to selling naked puts as opposed to doing a covered call position or a buy right, as it's called. And in this particular case, the stock doesn't pay any dividends. Neither of these stocks pay dividends. So it's not as if you're missing a dividend payment by not being long the stock. So I really like this strategy. I hope it's one that you learn more about. And again, this is more of an investment strategy that generates a really nice rate of return. This week, I'm going to be doing an educational video, and I'd really appreciate it in your comments if you gave me some ideas of the type of content that you'd like to have me do. I've been focusing more on swing trading, so please keep it more related to swing trading. Leave your comments. You know I'm going to respond. Thanks so much for watching this video, and I should have that educational video out sometime Wednesday. Trade well. We'll see you then. See how we trade live every day and take our 14-day free trial. I won't even ask you for a credit card. Dive into the action and trade alongside of us. Your downside is that you get some great trade ideas. Your upside is unlimited because you'll learn the skills that you need to be profitable. Check out OneOption.com and see for yourself.